Hello and welcome to Startup Street. I'm Shruti Mishra and with me is Arundhati Ramanan. These are the top headlines from the startup space. Flip Spaces, an interior design startup, raises $35 million in a funding round led by Iron Pillar and existing investors. The firm plans to use the funding to accelerate growth across India, US and UAE, also explore inorganic opportunities.
Logistics tech startup Shiplog secures 6.5 crore rupees in a seed round led by Deepak Bagnani Family Office. This marks Shiplog's maiden fundraising round since its inception in 2022. This capital will strengthen the tech infrastructure and AI-driven inventory management solutions.
InfoEdge achieves 36% returns from its early-stage investments in startups since 2007. In a letter to shareholders seen by CNBC-TV18, founder Sanjeev Bikhchandani writes InfoEdge's AIF investments alone yielded 18.7% returns. Further, the company and its affiliates have invested a total of 3,959 crore rupees, with the fair market value of the invested capital growing to 36,855 crore rupees today.
Jeff Bezos' personal firm, Bezos Expeditions, is leading a $72 million investment in artificial intelligence data solutions company Toloka, which is looking to scale up its business, Reuters reported. In addition to Bezos Expeditions, Mikhail Parakhin, CTO of Canadian e-commerce company Shopify, is participating in the investment.
It was a miss for Uber in revenue terms as growth in its ride-hailing unit slowed to its weakest since the pandemic. Uber reports nearly $12 billion in revenue while $2 billion in net income. Well, those were the headlines we've been tracking for you this evening. On What's Brewing today, AI-driven corporate transport as a service company Rootmatic, which offers a full-stack commute solution to over 300 corporates across 23 Indian cities, has raised $40 million in a Series C funding round led by Fullerton Carbon Action Fund and Shift for Good. Founded in 2013, Rootmatic has delivered over 5 million trips a month for more than 300,000 employees, powered by its proprietary AI technology. Joining me now to talk about how Rootmatic is redefining corporate transportation is its founder and CEO, Sriram Kannan. Sriram, welcome to Startup Street. As I mentioned earlier, this $40 million funding comes from Fullerton Carbon Action Fund and Shift for Good, both major players in sustainable investment. Tell us, how will this support accelerate your sustainability goals, especially the integration of electric vehicles into your fleet?
Yeah, so sustainability comes from two different angles. One is pooling of...
Sriram, I believe you're on mute. Can you unmute yourself?
I am on unmute. I am not on mute. Yeah, I seem to be okay now.
Yes.
Can you hear me now?
Yes, go ahead. Go ahead.
Yeah, so sustainability, we need to work on it along two different angles. One is the pooling of cars, even before the EVs come in. How do you reduce the number of trips? How do you reduce the dry runs and so on in the logistical space? And in addition to that, you also, bring in EVs to lift off some of the or most of the ICE vehicle runs. So it comes from both angles. So this kind of a sustainability focused funds backing us, two of the giants in the industry, will definitely help us to scale the technology that we have been improving over the last 12 years. And we call it the moving from the lab to the factory kind of a scenario now, where we are looking to scale it much bigger than where we are right now.
All right. So take us through your fund allocation plans. Beyond converting 30% of your fleet to EVs, what other initiatives, Sriram, are in the pipeline? And how will this fresh capital help Rootmatic differentiate itself from traditional players in the transport space?
So the traditional urban mobility play is either demand-focused or supply-focused or some sort of a glue logic. Our ambitious plan is to actually handle both the demand and supply on equal rank, and with the unit economics that help the driver to maximize their earnings, right, by packing as much as possible. So as a thesis, we buy out the time of the driver and maximize his earnings rather than just capture supply or just capture demand and not knowing what to do with it. So as a primary step, we are going to be setting up our ROCs, Routematic operations and command centers in large cities. We are starting with the 5 cities. We are already present in 3 cities already. So the ROCCs will help us in managing the transportation across corporates through centralized command centers in every city, that are both demand planning and supply matching at the same time. These are going to be state-of-the-art outfits that we are going to build. What we already have, we are going to spruce up. And like I said, the experience for our corporate clients who are always very demanding is going to get even better with, at the same time, maniacal focus on improving the outcome for the driver.
Sure, but you've got 300 plus corporate clients and millions of trips each month. How is your AI-powered SaaS platform transforming the employee commute experience? What kind of operational efficiencies and, of course, cost savings are you delivering to your clients? If you could throw some light on that.
So corporates are always looking for three things. Point number one is compliance at 100%, right? Any compromise on compliance, be it on the driver side or the car side or the law of the land, is to be no compromise at all. So we deliver 100% on the compliance factors, and it is all tech driven. Point number two, they are looking for metrics in terms of on-time arrivals and departures, right? We promise and sign off on 95% on-time arrivals and 100% departures, right? Arrivals help the corporate, timely departures will help the employees and having higher level of satisfaction that they are not sitting around in the car. The third thing being cost, right? This is the pecking order that corporates are looking at. This is exactly what we are going to be doing.
Okay. Sriram, you've also set an ambitious target of scaling your fleet to 10,000 vehicles by 2026. How do you plan to manage this kind of growth, and what role will your city-level command centers play in this expansion?
Very good question. So what Routematic has been doing from beginning, from 2013, it's a 12-year-old outfit now, is that we have captured a large volume of demand to the extent that we already are operating with about nearly 70,000 fleet on the platform, right, in the planning space. And so it is not such a long shot to actually look at acquiring a 10,000 fleet scenario. We are at nearly 3,000 right now, 2,500, 3,000 right now. Yeah, so we are going to be capturing them. And given that corporate transport has a certain pattern to it, it is much easier for a corporate player having aggregated city-level demand from corporates. And now we are also looking to other B2B segments like airport transfers and so on to maximize the utilization given a time. So it is not such a big deal for us to actually get to 10,000 because, like I said, the platform has already shown capability of handling nearly 70,000.
All right, one final question before I let you go. India's employee transportation market is projected to hit $13.2 billion by 2030. What are the biggest opportunities you see for Routematic in this growing space?
So while the employee transport is one large segment, like you said, it's nearly $14 billion. We have much bigger ambitions of actually coming up with an entire DRT platform. What I mean by that is demand responsive transit, where you design for projected demand and design supply for it, rather than the current state of the art, which is design supply, float supply, and expect people to be taking those cars, right? So we are looking at not just employee transportation, but that will definitely set a very huge base for us to play with in terms of improving our utilization. But we have much bigger dream of coming up with an entire demand responsive transit DRT platform, which is actually expected to be over $2 billion by 2030.
All right, and we wish you the very best for that. Many thanks, Sriram, for joining us on Startup Street. Appreciate your time.
Thanks, appreciate it. Thank you. Yeah.
All right, moving on. Also on What's Brewing, Sadhav Offshore, a key player in India's maritime services sector, has raised 25 crore rupees in an equity funding round led by the Unique Undiscovered Value Fund, with participation from several prominent family offices and high net worth individuals. Now, the funds will help launch a critical floating dry dock facility, vital infrastructure in a country where naval and commercial vessels often travel abroad for repairs. With a growing focus on defense readiness and domestic maritime self-reliance, joining us now to talk about what this expansion means for Sadhav Offshore is its director and CEO, Devahuti Chaudhary. Also with me is my colleague, Arundhati. Devahuti, welcome to Startup Street. Now, given the tensions between India and Pakistan and the strategic importance of maritime readiness, how is Sadhav Offshore contributing to strengthening India's defense preparedness, especially when it comes to quick turnaround times for naval and coast guard vessels?
First of all, Shruti, thanks for having me here. So yes, it's a tense time for everybody involved. We have already expressed, as Sadhav, we have already expressed our support to the Indian Coast Guard and the Indian Navy for whatever we can do. When it comes to quick turnaround time, Sadhav is known. It has a track record of completing refits before the sanction time and with quality. And therefore, customers like the Coast Guard and Navy trust us to complete projects before time. So early delivery means that the ship remains operational for a longer time to carry out its charter of duties. But this itself is a game changer, you see, and it creates a huge value for our national defense systems and also for the commercial shipping industry. But yes, this is very helpful for the defense.
Sure. Hi, Devahoti, Arundhati here. Now, shifting focus to the fundraise, right? One of the key focus areas for the round is the launch of a large floating dry dock. If you could sort of explain why this is such a game changer for India's ship repair industry?
Yeah, so basically the floating dry dock is basically a facility and infrastructure which where a ship comes and we are able to access the underwater hull of the ship for carrying out repairs. Now, basically over the last few years, what has happened is that the government has, kind of given the existing public infrastructure to PSUs like Cochin Shipyard and GRSE. And these PSUs focus on carrying out naval repairs. And naval repairs typically take a very long time. So as a result, the other ships, they don't get access to the dry dock infrastructure and they have to travel great distances for their repair requirements. Secondly, what's important to note is that this floating dock would be set up in the heart of the industry. Like the shipping industry is, like Bombay is the shipping capital of the shipping industry. Maximum number of ships that operate in India are actually operating around Bombay. And your ship repair ecosystem is in Bombay. Your ships are in Bombay. So everything is around here, which basically, once the infrastructure comes up in Bombay, it means that the ships can be repaired faster, and it's a huge cost saving for the industry. And that's why it's a game changer.
Absolutely. Absolutely. Yeah. And Devati, you've been operating the Paradip Port dry dock since 2013 and are already servicing a major share of the Indian Coast Guard's FEP fleet. How will the new facility scale up your capabilities and client reach, both commercial and defense? If you could quickly answer that.
Yeah. So every infrastructure has its restrictions in terms of the size of ships it can cater to. So, for example, at the Paradip facility, we can basically dry dock ships of the Coast Guard of up to 50 meters in length. We cannot dry dock offshore supply vessels because of the beam restrictions. But at the new floating dock, where we can dry dock ships up to 130 meters in length, we will be able to cater to Coast Guard ships of 100 meters to 150 meters in length, one ship at a time. Or we can do 2 offshore supply vessels at a time. Or we can do multiple tugs or smaller vessels at a time. So that changes the scale of the business significantly.
Right, absolutely. And India is also aiming to become one of the top 5 shipbuilding nations by 2047, right? How do you see Sadhav Offshore aligning with the government's vision, particularly through initiatives like Sagarmala and Maritime India Vision 2030?
So being a ship repairer per se, we are already aligned. And actually, while this the Maritime India Vision 2030 has been announced more recently, but the workings have been going on for the past few years. That's why we are able to set up the ship repair facility in Bombay. But Sadhav has been designing and building boats by itself. We've been working with DPSU yards like Mazgaon docks and all to build warships and submarines as well. But as a shipyard for shipbuilding, we have a tie-up through our sister concern with a foreign partner to set up a shipyard which will cater to shipbuilding in Paradip. So the economics of shipbuilding as such requires you to have deep pockets because ships, as you know, are very expensive assets. And a shipyard has to manage the production of multiple ships at a time because otherwise the economics will not make sense. So you have to manage production of multiple ships at a time while waiting for milestone payments from your customers. So for a small company, it's actually a difficult exercise. So that's why we have entered into this kind of MOU for a joint venture, and we'll be suitably be able to cater to the shipbuilding requirements.
All right. Devahuti, like we were discussing, ship repair is often seen as a slow-moving traditional sector. How is Sadhav Offshore bringing in innovation, whether through partnerships like the Kongsberg Maritime or new tech in dry docking and maintenance?
Yeah. So, well, actually, ship repair is not slow. It just looks slow. It is a traditional sector. So, as a layperson, you may not be able to visibly gauge the entire gamut of activities that are going on, because so many people are working on so many different areas of the ship simultaneously, and this requires a huge amount of project management. When it comes to innovation, basically, yes, there is a limited amount of innovation you can do. Where, like, for example, for the floating dry dock, we plan to use robotic hydroblasting systems. So this will enable us to, kind of blast the ship's hull in a much faster, with a much faster way, and have a much faster turnaround time. But other than that, one has to kind of modernize the way ship repair is done. So for that, we are basically, taking a lot of steps. One is we have made Paradeep into a center of learning and excellence, where we are training new recruits in ship repair processes specific to our sector, which is a very small sector, so to say. And we're taking a leaf from like our partners as Rolls-Royce Marine, which is now being taken over by Kongsberg. So we're basically converting tacit knowledge, which our engineers have, to recorded knowledge. So this basically, with the experience of the engineers, we'll be able to kind of
Sure.
And also we're implementing systems where we'll be able to record and use AI.
Absolutely. And, we're running out of time, but if you could quickly tell us, speaking about this, and, you're talking about the opportunity here, but most Indian ships currently head overseas for repairs, right?
Yes.
So what's the scale of opportunity for domestic repair infrastructure, and how soon do you expect the demand to translate into revenue?
So the industry estimates of the domestic ship repair industry is like about 4,000 crore, which
Sure.
definitely will and can increase if the ships that are going abroad for repairs come into India. 80% of SCS is actually refitted outside. One thing is that there is non-availability of dry dock infrastructure. Secondly, there is a skill gap, because we don't have the skills to actually dry dock bigger ships like bulk carriers and container ships like 250 meters in length, etc. And thirdly, when these ships go abroad, they can very easily go to a dry dock, which is en route. So basically, we are trying to cater to ships that are operating in the coastal waters of India, which is basically your offshore supply vessels, coastal ships, coast guard ships, etc. And once a floating dock is built, this will immediately translate into revenue.
Okay. All right, Devahuti, we've completely run out of time, but many thanks for joining us on Startup Street, and wish you the very best for your growth plans.
Thank you so much for having me here.
On that note, it is time for us to head into a short break. But coming up next, Greengrahi has secured 32 crore rupees in a seed round. We put the firm's founder on the hot seat to find out more about their growth blueprint. Stay tuned. Welcome back. You're still with us on Startup Street. A next-gen startup using insect biotechnology, Greengrahi, has just raised 32 crore rupees in the largest ever funding round for the sector. Backed by Avana Capital and other marquee investors, the company is redefining how we think about animal feed and farm inputs, with solutions powered by the black soldier fly. From improving shrimp yields to boosting crop health, Greengrahi is building for both scale and sustainability. Joining us now to talk about the company's journey and future plans is co-founder Siddharth Sharma of Greengrahi. Siddharth, thank you so much for taking time out and being here with us on Startup Street. Before we get into the details of the fundraise, right, at Greengrahi, you guys use insect biotechnology to create alternatives to traditional animal feed and chemical farm inputs. If you could sort of take us through what you have on offer in sort of layman's terms.
Yeah, absolutely. So first of all, thank you for having me on the show. So at its heart, Greengrahi is an agri-biotech company. We create alternative proteins, fats, and supplements, as well as biologicals and biofertilizers using insects. Now, these insects are fed on agri residues and agri byproducts that we get from different food processing companies. So in a way, we are turning these low value residues into high value inputs for both animal nutrition as well as plant nutrition and protection industries.
Absolutely. And if you could sort of, take us through the kind of demand that you're seeing for your offerings, the kind of clients that you're catering to across which sectors, and how is your offering more cost effective and scalable versus traditional animal feed?
Absolutely. So Greengrahi is working across various sectors. As I mentioned, we're working on both animals and plants. Within the animal nutrition space, the demand is from shrimp industries, it's from aquaculture as a whole as well, then poultry industry, and even pets. And each of this sector has a unique value proposition that they see in us. For example, in poultry, we are able to increase the yield of the layer hens, which are basically the egg-laying hens, by up to 30%. In shrimp, we are able to increase the yields by up to 7%. Similarly, for pets, which are more like companions and family members now, we are able to reduce their allergic reactions. We are able to improve their gut health and even the skin and fur quality. And these are few of the tangible benefits that the consumers as well as the large feed companies are able to witness. On the plant nutrition side, as a biological company, we provide them with inputs that help the farmers reduce their dependence on chemical feeds and chemicals, as well as increase the yield of their crops and their income as well. So on both animals and plants, we have demonstrated our performance, which has in overall resulted in LOIs worth close to 550 crores that we have received in the last 2 years. And just to cater to this demand, we are setting up a new factory through this fundraise, which will cater to a part of this demand that we have.
Sure. So you've sort of, pointed out there all the material impact that these particular, your offerings have. And you also said that you're going to use some of the funds that you've raised for a new manufacturing plant. But if you could also tell us how else will you spend this 32 crore rupees? How are you allocating it across key areas like manufacturing, R&D team expansion, as well as market entry?
Yeah. So we have basically segregated the fundraising in three segments. One would be definitely the enhancement of our manufacturing capability, but the second one is as a company we are deeply focused on R&D. So we want to double down on our R&D efforts, develop more formulations for problems that are coming up through because of the climate change. For example, white spot disease, which is happening in shrimp and results in almost 20-30% loss to farmers. Similarly, the reduction in the crop yield that happens because of extreme summers or extreme rainfall. So these are some of the new problems that we wish to solve for using our ingredients. The third segment is on global expansion. Pet food as a segment is growing rapidly in the US, and EU, and UK. And we already have a lot of incoming demand from large pet food manufacturers who want to use our ingredients not only to as a replacement to conventional proteins, but also to differentiate themselves from rest of the pack. So these are the three key pillars that we'll be targeting through the fundraise.
Absolutely. And with Greengrahi sort of entering or looking at these international markets like the US, UK, and EU, as you pointed out, what sort of regulatory, supply chain, or scalability challenges would you face, and how do you plan to overcome them?
Yeah, so EU was the first, geography to recognize insects as a potential feed ingredient for animals. They have laid down a list of requirements that any feed-focused insect company should be following. So we'll be following those regulations, which basically govern what kind of food can be given to insects. Apart from that, these are standard regulatory practices. GMP, HACCP, and Capexel are three licenses that a company needs to have to ship out their products to US and EU.
Right. And if you could sort of, talk numbers now, take us through the kind of revenues you're currently clocking. What portions of Greengrahi's projected 510 crore rupee LOI, as you said, is expected to convert into actual revenue over the next year or two?
So once the factory is commissioned, we expect to get around 40-45 CR per year from the first commercial unit. But we do not wish to stop there. We want to be the biggest player in this segment across the world. So we'll be setting up multiple of such units, medium to large scale units across India and then soon globally. The 550 CR LOI, which I mentioned, is just from India. But the demand is much bigger as we look at other sectors, including if we deep down in the pet food sector in the US and UK.
Sure. And if you could quickly tell us, how are you sourcing this feedstock for your insect biomanufacturing at scale? And what are the kind of environmental or logistical implications of the sourcing model?
So as a company, we are a full stack insect biotechnology company that also differentiates us from a few other companies in this space. But in terms of the only dependency that we have is on the raw material, that is the feed for the insect. This is something that we are getting from large food manufacturers. So companies manufacturing chips, they can give us potato peels, which generally get wasted. Companies producing, or companies in the alcohol industry, we can take spent grain from them. Similarly, all the big push on the bioethanol, so we can take all the DDGS and DWGS that these companies are producing. So there's no dearth of feedstock availability in India. India is rich in and has a lot of these feedstocks easily available within 50-kilometer radius of any geography. So yeah.
No dearth of feedstock there. All right, Sadhav, thank you so much for taking time out and being here with us on Startup Street, and we wish you all the best going forward on your journey.
Thank you for having me.
Well, let's take stock of all the other startup stories. Now to the latest on Gensol Blue Smart fiasco. Another setback for Gensol Engineering. The Delhi High Court bars the companies from selling or transferring rights of over 220 additional electric vehicles leased from separate lessors. As per the ruling, the court will be appointing a receiver to take charge of these vehicles. The court also directed Gensol to submit a status report on the leased electric vehicles within 2 days. Additionally, Gensol and Blue Smart were ordered to provide a detailed disclosure of their assets and liabilities.
Uber's first quarter numbers beat expectations but fell shy of anticipated revenue growth for the quarter. Revenues at the ride-sharing firm grew 14% to come in at $11.53 billion versus the $10 billion for the same period last year. The company also reported a net income of around $1.78 billion versus a loss for the same period last year.
Staying with earnings, car trade shares skid in trade after the company reports its fourth quarter numbers. Its net profit was up by 86% at 41 crore rupees as against 22 crore rupees in quarter 4 FY24. The company's net revenue rose by 17% and EBITDA increased by 68%. Further margins saw improvement.
Meta wins a lawsuit worth $168 million against Israeli spyware firm NSO Group. A US-based court ordered Pegasus spyware maker to pay the compensation after it found the company guilty of targeting WhatsApp users using Pegasus spyware. Calling NSO Group a notorious foreign spyware merchant, Meta said, and I quote, "The verdict in WhatsApp's case is an important step forward for privacy and security," end of quote. This is a 6-year-old lawsuit whereby Meta had sued the group for hacking 1,400 WhatsApp accounts.
And with that, it's a wrap from Arundhati and me, Shruti, on this edition of Startup Street. More news and updates coming up on the other side. Stay tuned.